CPA firm, Frost, which is now Deloitte & Touche. Been in Anderson since 1981, and as you said, I now own my own firm. I just keep going smaller. Started with a national firm, go to a small local firm, and it divides, gets smaller, and now I'm on my own. So my next move is just out of the profession. So I really like what I do, and finally, after 40 years, I finally get things figured out. So now I'm really enjoying it. So I'm not really looking to retirement, but I suppose that'll have to come at some point in time. I do a lot of things. Our firm does auditing, we do accounting, we do reviews and compilations of financial statements, corporate individual taxes, not-for-profits. Not-for-profits, particularly interesting area. And we also have worked in litigation, particularly in divorce, either in terms of doing valuations or assisting with the division, identification and division of the assets between the spouses. And unfortunately, in today's world, there's a lot of that to do. I'm accredited in business valuation, so I am CPA/ABV, and that accreditation comes from American Institute of CPAs. The company itself, that we're small, little people, myself, my office manager, who's also my wife, Leanne. Jacob, or Jim Gosen, is what he likes to go by, is a senior staff member. Very, very proficient. Technically, he can do anything that I do. The big thing is that I also manage the company and set the direction. New person is Sonia McCain, who's been in accounting for over 30 years and started with us in January. On a day-to-day basis, we have recurring business clients, and we get a number of referrals from attorneys, existing clients, and also other CPA firms. Get a number of referrals for valuation work from some of my friends in the profession. And what we do is, look at it as big, we provide timely and accurate information that helps businesses, business people run their business. We do some backroom accounting. Not as much of that as we did at one time. Of course, we do tax planning preparation with the goal of helping people plan for and minimize your tax liabilities. And then we do quite a bit of consulting work, not only in terms of valuation, but other tax planning and assistance with major decisions. Specifically, on a day-to-day basis, if you were to come to work at a firm like ours, there would be a lot of work done with QuickBooks. As far as my clients, probably 98% are using QuickBooks, which is a big, major shift in how we work from, say, 30 years ago. 30 years ago, the small CPA firm would typically be keeping the client's books, but we'd actually be getting a check register, recording the checks, recording the deposits, making journal entries and preparing monthly financials, but having handled all the raw data. Today, most of the clients are handling their own raw data. Most of them are reconciling their own bank. And then we come in either on a monthly, quarterly, or annual basis and make the entries in QuickBooks, clean it up. Usually, there's varying degrees of cleanup required, and that is at least a lot of what we do. Some areas that clients tend to not get done is accounting for fixed assets, recording the depreciation schedule, which, by the way, is getting more interesting. Is Internal Revenue Service now says that assets are less than $2,500, we no longer have to depreciate them. We can just expense them without even using the first year expense election under Section 179. We don't even have to do that, you just expense them. Which does create an interesting situation because the Indiana Department of Revenue and the Department of Local Government Finance have a different opinion for the personal property tax return. So they're not agreeing with the IRS. For example, like small places like my office, we buy very little equipment. Very few things that we buy are over $2,500. And if I was to restart my firm today, I probably wouldn't have a depreciation schedule. It is a different world. But yet, where it gets interesting on a day-to-day basis is you still have financial statements going out. You want to go to your lender, and you like to show a few assets. And so we have this conflict between accepted accounting practices and what we do on the tax return. And we have ways of dealing with that. We still do a lot of payroll tax returns, not as much as we used to, but still it's a good opportunity for a CPA firm. Nice thing about when you do the payroll taxes for a client, or when you do the payroll for the client, you're seeing the client every week. Someone in your office is seeing someone for the client every week. It's a great relationship builder. It's also a very important service because payroll is an area that if clients make a mistake in payroll, it can get very expensive. If payroll, the taxes aren't deposited correctly, the penalties are onerous. Plus, it's a mess trying to get it back together, and the W-2s need to be properly prepared. As I said, we do all types of income tax preparation services, tax planning. There are personal property tax returns to do. Not as much as it used to be. There's an exemption now, so that's a big change. Depending on your client, there's other returns to file. We're not doing anything right now, but we were doing a client that was a tanning company, and of course there's an excise tax on that. State fuel tax returns. I don't presently do those, but we've done them in the past. And if you're not doing these things, you're also consulting with the client to make sure that these excise taxes get done, because they can sneak up on you, because it's not necessarily in the expectation of the CPA firm, but if the client's not doing it right, that can get very expensive to them. So you work with them to make sure their systems are set up to capture the data. Sales tax returns are another pretty big area, and an area where clients can get tripped up on what's exempt and not. We do reviews and audits of financial statements, and those are generally for banking relationships, also for insurance companies, bonding companies. They want to see a financial statement for contractors. Fair amount of business valuation and consulting services. Talk a little bit later about in more detail about business valuations, but very often that, I'm currently working on one where my client that owns a number of fast food franchise restaurants has an opportunity to buy 3 more in another city, and so we're evaluating what they should pay for that. CPA firms often do what we call controllership activities, where basically the client says, "Will you just do it for us?" And there is still some of that, not nearly as much as it used to be, or it's different in that CPA firms basically taking over the books. It actually, instead of starting with maybe a check register, CPA firms actually generating the checks. And that could be the accounts payable checks, of course the payroll checks, but also recording sales. We don't and haven't done in the past. We haven't done a lot. Generally, clients are taking care of their own receivables. But what you do if you're doing controllership activities, you'll help capture that data and bring it into the general ledger. What's the expectations of staff? As some of you may end up working in the CPA firm, probably going to be a little intimidating when I have new staff come on. There is so many different things going on in our firm. It's a little hard to get people focused, and they just see this a lot of things to do, and where do we start? So CPA firm owners, they're going to know there's a learning curve. And they'll start you out on something small and just kind of work you through the process. But we don't have a formal training program or anything like that. But what we do is give you something to do, work with you on it, and as you learn, we'll give you more. I heard someone say today, get up and walk away. I just happened to overhear that. And as you're working with the data that we work with and various different levels of client abilities, and sometimes the things we work on, they're just hard. And every once in a while, you just have to get up and walk away. And just, I now own my own firm, and now I also own my own office. The first time that I've owned my own office, we purchased the building in 2014. And so now the sidewalks need cleared. I'm the guy. Weeds need pulled. I do that. And there's always something to nail or clean or fix. And I just find that every once in a while I just get up, walk around the building, find a weed to pull out. And you just have to get away from it every once in a while and then come back to it. Some of the things that you'll be expected to do, if you're doing a tax return, you want to document where you got the information. Most of the major information is going to be on documents, reporting documents, W-2s, brokerage statements, 1099s, all types. But there's also going to be other information. For example, say on a rental property, the client's tenant might have been a business. They might have given them a 1099 for the rent. You want to make sure that agrees to what the client thinks the rent is. But then you'll have the expenses on the rental property, and that'll basically be provided by the client. And you need to review that, document where you got it from, make sure it looks like real expenses. And same thing as a business. You need to, while we don't audit clients, clients' records, there are certain things that you do need to look at. And one of the things I throw out is the insurance account. When the client says insurance, you need to ask for the detail. Because insurance is business insurance, casualty, fire, liability. Insurance is also, well, it could be annuities. We buy that from an insurance company, which is an investment, has nothing to do with the operations of a business. Could be life insurance. Could be a number of things. And you just need to make sure that you know what it is. We have a list of what I call sensitive accounts that you need to look at because clients tend to not. Clients come from the standpoint, this this is how they look at it. And you have to know this when you do a tax return. Clients go, insurance. Is insurance deductible? Is whatever deductible? Are utilities deductible? And that what clients don't understand. If you're doing a 1040, if you're doing itemized deductions, that's a proper approach. Interest expense is deductible under certain circumstances. Contributions are deductible if you meet the requirement. But when you get in the context of a business, it's different. Most deductions, deductible expenses come under Internal Revenue Code 162. Ordinary necessary business expenses. They aren't detailed. Exceptions would be meals and entertainment, travel. They have their own section. But while they're ordinary necessary, they also have their own requirements. But the clients don't understand that, and that's where you have to come in and say, you really can't deduct the diapers for your pampers for your child and business and things like that. It's how the expenses relates to the business and not necessarily what it is. I heard you talking about working on tax software. Most of these programs will have diagnostics as you have to input the data. It's good to review those. Although we use UltraTax, and they tend to have a diagnostic for everything. So it's like you do the return, a simple return, and it's got 20 diagnostics. Oh my gosh! And most of them are quickly, you can see it has nothing to do. But it's good to follow up on those, because they will do things like, hey, based on how you input things, you really can't take the earned income credit. And it's good to know that, those kind of things. And then you can go back and review your input, review your situation, and make sure that you haven't made a mistake if you haven't done something that you really can't do. Again, the software that I have used, that I'm aware of, you can follow this trap that it's going to catch everything, and it doesn't. And it's still possible to file an incorrect return using computerized software, because it still goes back to what you put in. And every once in a while, there's an error in the software. Our UltraTax software, all tax season long, there are updates. The tax law is extremely complex. And sometimes there will be rulings from the IRS like during tax season, but things are not cleared up. So you have to watch that and see. You want to document what your source was, so you can go back and explain to your supervisor.
What do you do if somebody gives you a handwritten receipt, and then you're trying to decipher if it's real, if it's a real expense, or how do you make that decision?
First, you have to know what it is and understand the nature of it. As far as we're not doing an audit, and actually somebody just writes down my expenses were such and such, just because of a matter of judgment. I'll give you an example of one where I said no. The client gave me what they considered to be their business mileage. And I forget how they did. I think maybe they gave me an amount of business, travel expense, auto expense, gasoline in the auto, something like that. And anyway, I did a little analysis. I thought it looked a little high. Did a little analysis of it, and based on that, they could have gone around the world. And then in this business, if they were grossing like $5,000, I threw it out, and actually the client left. And I said, I can't do it. I'm not doing the return. So it's a matter of judgment. If you audit everything, well, you're not going to have many clients, and they're not going to be able to afford you. So it is a matter of judgment. And the good thing, a good policy is to work with clients you can trust. And as soon as you see you can't trust them, you need to be out of there because they're just bad news and it's time to move on. As you turn in your walking.
So on that subject, so does your clients bring you everything like already added up, or do they just bring you like piles of receipts and you have to go through them and figure out what goes to what, or which do you get more of?
We get both. It's probably somewhere in between.
Okay.
Typically, they don't total things up. They'll give us a list of the document or a list of, for an individual return, we send out an organizer. We've done their work before, so they have some idea of what we're looking for. And
right, but I mean like a small business, because I have my own cleaning business I did for over 20 years, and I used to have a lady who helped me with my taxes, and I would pretty much add everything up and then take it to her, and then if she had a question on something, I'd show her, where I got it from. But then after a while, I've been doing my own taxes now for probably 10 years. So, but like you said, everything's different. It's always changing.
We typically get the QuickBooks file. We actually will get a backup of we don't do a lot where the client just writes out the business. We don't need many businesses that are that small. Most of them have a bookkeeping system. But there is some of that. But generally, we'll get the QuickBooks file, and then there's specified things we ask for. And after a while, after clients have been with us a few years, they grow into that. And then there's always a few that is an absolute disaster.
Well, I just learned the QuickBooks last semester, so that's something that I'm looking forward to use for my business. Basically, my stuff's all written out. I just did it the same way for years.
Yeah, you'll find that it's a good way of doing things. It's really nice to see how you're doing, but also to looking at your expenses and what are they.
Mm-hmm.
And then as you turn things into your supervisor, you'll probably get some review notes. So just learn to appreciate the review notes. Appreciate the reviewer, even though sometimes it gets a little old. And there's varying degrees of review. In my former firm, I had a partner, and my partner was described as the nice reviewer, and I was described as the mean reviewer. So they would actually prefer to give things to him, but hey, it wasn't right. I just tended to be, okay, I was picky. I was still picky. But you should learn from the reviewer, not take things personally. And not be afraid to turn something in, because you can't hold it forever. Eventually, you got to let it go, and that's why we have a review process to make sure that there's not something obvious that's been missed, or to look for opportunities and second pair of eyes and go, well, it's really not wrong, but we could have done this, and for the future, this might be a better way of doing things. Client accounting, whenever you do a financial statement or when you work through the QuickBooks, you should always have, in tax return, you should always have like an expectation of the result. My former partner, when Okay, I didn't think he was a picky enough reviewer, but he would always ask the staff when they would bring in, whether it be an annual or monthly client work to review the financials and QuickBooks and everything, he would always ask them a question: how did they do? And it's amazing how many times the staff person didn't know. Because it is very easy to follow this track of you learn a lot of things here in class. You learn more. You will learn every day, and you learn procedures and things to do. And sometimes you can get locked into those procedures. And I thought it's just like looking at the trees and not the forest. It's very easy to follow if you start digging into an account and digging into the details. It's easy to forget where are we? Is my gross margin anywhere near what I expected it to be? And so you always want to know how they did. You'll always be able to answer that question. Then there's more to it than that, but you just have to make sure you're always looking at the total picture. And does this set of books that I have now created, this financial statement, balance sheet, and income statement, does it make sense? I know what balances, I know the cash balances, and I know things tie out, but does it make sense? You just make sure you haven't missed something big. In our firm, we number one, we always make sure the bank's reconciled. If the client hasn't done it, then we're going to do it. But make sure that the accounts receivable, if the business that has receivables, that they tie out, and they should. As is QuickBooks, they should. But the thing to look at there also is look at the aging of the receivables. Because to me, if the receivables are extremely old, it means one of two things. They could just be bogus. They've already been paid off, and it just didn't get credited to receivable, it ran through income or something like that. So in other words, they double dipped their income. Or it could be that it's a bad debt. It's a debt that's not going to be collected. It should be written off and expense taken. And also find that sometimes I have clients that don't really look at their accounts receivable list. And it's good to remind them, oh, you've got all these people that aren't paying you. You might want to follow up on them. Because people get trapped in doing the business, doing the sales, doing the marketing, taking care of the clients, and sometimes forgetting to see that they're not getting paid. And why are we not getting paid? Well, it could just be a delinquent client, but it also could be the clients aren't happy. That's one way clients or customers tell you that they're not happy, they don't pay you. So it's a good thing to follow up on. We will tie out accounts payable. Make sure that the listing makes sense. And again, if they're really old, then you have to wonder why. Is it company having cash flow problems, or are they not valid? Looking at the bank records, kind of back up a little bit. One thing we'll find in QuickBooks especially, because it's so easy to reconcile a bank statement on QuickBooks. You just do it, go through, click off the things that cleared the bank, and you just say reconcile, and it does, and it prints this report, and we forget to look at it. It's very easy, balanced, good, put it in the work papers, tie it out, and say it's all good. But forgetting to look at the list of outstanding checks and deposits. And I don't know how many times I pulled them up and looked at it and going, there are a lot of outstanding checks. And again, it's the same type of thing. The check's been reissued. It never was valid in the first place. Somebody put it in, didn't mean to have it in there, and it just needs to go away. Or it is a valid old outstanding check, and typically this is a payroll, which is amazing to me. I've never figured out why people will leave a company and not collect their last payroll check. It happens a lot more than you would think. I know if I left the company, that's the first thing I'm going to do is get my last payroll check. But anyway, when that happens, that is unclaimed property. And it needs to be reported to the Indiana Attorney General's office. And if you don't, they have a penalty.
For the company?
Yes. And it's $25,000.
Wow. And the check could only possibly be for $200 or something.
Yeah, I mean, the penalty is, so that's a reason to follow up and help your client and say, this situation needs to go away. Find the person, take care of it, do what you need to do, but don't leave this list of checks hanging. Other thing we'll do is, of course, notes payable, other liabilities, things like that. I'll make sure there's some documentation.
When you were talking about the account receivables, sometimes we talk about in our 101 class, do you keep two sets of books for any of your clients? A GAAP book, accrual, or cash basis, or do you do all of everything in accrual, even for tax purposes?
We do that for some clients. It depends on the client's needs. I usually, if the client is keeping their books on the accrual basis, that's the books. There are some that then want to file on a cash basis, and we do that for some. I generally find if I have a choice, there's one set of books. A couple of reasons. Number one, it's easier. And you're not always having to say, well, you made all this money, but there's more money on the tax return. So but in some cases, it is necessary. But probably the biggest area where we keep two sets of books is on depreciation, because you have such tremendous write-offs available. So basically there isn't a tax depreciation schedule anymore. Either things don't make the schedule, or we have the first year expensing, and someone buys a piece of equipment for $300,000, they just write it off the first year, which is really good when you're giving your refund on your taxes and everything. But when you go to the bank and you show your banker your balance sheet, it shows nothing.
Because you wrote that off.
Because you wrote it off. So what we'll do for clients that...
So is it not an asset anymore?
It's still an asset. It shows as an asset, but then it's got the accumulated depreciation that's equal to it, so it nets to zero. So it's still there. But we will, for clients that have banking needs, we'll run more of a GAAP depreciation schedule where we actually depreciate
it out over years
over the expected life. Or and what do we do for a lot of them? We'll still use a tax method, but we'll depreciate the asset over the 7-year tax life. Which it just number one looks a lot better when you go to the bank. Of course, it's the right picture, but also bankers like to do ratios, and if your fixed assets are zero, it doesn't make your ratios look good. So we do some of that. So we try to avoid it as much as possible because it does get confusing. As far as working with your employer, my recommendation, I said you should create expectations, but you should try to exceed the expectations. I try to come to work like this every day. I have an attitude. I'm ready to go get it. It's just no matter what's going on at home, church, everywhere. When I walk through that door, I'm focused. It's a different world, and I'm there. It's time to go home. I'm focused. I'm ready to go. I'm here for a purpose, and I'm not just mechanically going through things. And then at 5 o'clock, I leave, and the goal should be I leave the office there. Now, reality, at home, I'll be thinking about stuff, but really the key thing is to focus, have an attitude of trying to serve your clients the best you can, and to exceed your employer's expectations. That's how you really move along and move up in a CPA firm. Talk a little bit about marketing. I don't really do much marketing. I'm terrible at it. It's kind of like, I guess I should have done some marketing. But from my standpoint, my marketing is 40 years of service and relationships built. The phone is always ringing. But the reason the phone is ringing is because I have these relationships. I have relationships with attorneys, other CPA firms, my existing client base, other professionals, financial planners. We have a lot of people, for example, who need help with their investments, but we don't do that. I have my opinions on it, but I'm not qualified to do that for someone else. So I will refer them, and it is just good to find people that, as a CPA, I can refer my clients to, and get rewarded by getting referrals back. And that's important to do, is to build relationships with other people. Yes.
When you're first starting out, I know yours is different because you've already worked 30 years before you started your business, but how does someone get clientele if they're new? They just graduated, say, I don't know. How do you build your clientele?
Well, one way is to purchase a CPA firm.
Okay.
Usually that's problematic because that takes money, and we're just starting out and we don't have any money. I don't think it's a particularly good way of doing it anyway. Because although it does happen, it probably works better with an existing CPA firm merging another CPA firm into their practice. It would be really tough. But the best way is just to build relationships. The people you know, you try to meet other professionals and other who are also trying to do the same, who are already committed to other CPAs. It just takes a while to do it. I will say this, I've never gone hungry. and there's a lot of work to do. So there are definitely some opportunities out there. Join the Chamber of Commerce is good. And Anderson, the Madison County Chamber is doing a lot of good things, have a lot of events. So go to places where you can meet people.
From the community.
Right. Yeah. Look for networking events.
Business referral groups is good.
That's good.
You've gotten clientele already, and
well, even if you don't, if you can get into a business referral group.
they have one at Chapter B&I in Muncie.
I was in B&I. I actually found it very good. I'm not in it right now because my chapter was fired. They didn't think we were big enough. That was strange. I think they have some B&I. I think they have some really wacky
They have weird rules and stuff. My ex-husband / boyfriend, whatever you want to call him now, he has his own painting business, and he's been in BNI for over 15 years with a monthly chapter. And it seems to be okay, and people get in there and they want to run it the way they want to run it and make their own rules. And
Yeah.
but he's all of his painting business for the last 15 years has been by referral only. He doesn't advertise.
Yeah. So for BNI monthly has been around a while. It just hasn't been very successful in Anderson.
Oh.
I mean, we were successful. We had 14 in the group. I have my second largest client came from that, and some other large. I think as a CPA, it's not like you're going to collect a lot from that.
Right.
But when you do collect, it's big. So for a group like that, my recommendation would be find a way to live with the rules, live with the people who really have, in my opinion, no business in the group.
Yeah. There's a lot of good people,
Yeah,
successful around monthly that's in the group. A lot, a lot of relationships you built over the years.
Yeah. And that's the ones, you just concentrate on those because, and I say they have no business in the group. There are some I think have no business in the group. But they're also, in a group like that, you'll have, for example, you have the Mary Kay people. They have no value to me. I have no value to them. But they have other people in there that they can work with. So you just need to focus on those people that are most beneficial to you. And I would say that is a good group, but you just have to be very patient with them. But it is effective. Administration, day to day. One of the things you learn in the CPA firm is just this thing called timekeeping. There are firms that say they no longer bill by the hour, but I actually haven't figured out a way to do that without greatly understating my revenue. When I figure that, when they convince me that I can do it without going bankrupt, I'll be glad to do it. But until that time, I don't see the keeping the hours by the client going away. So you have to really be diligent about it. It's really easy to get away. That the time is actually spent on the client needs to be documented, needs to be inputted to the system. You need to account for your time. And I do this internally myself. I will start, today was an exception because I came here. But normally what I do is I start 8 o'clock. I will write down the number 8 o'clock. And then I'll say I'm going to work till noon. That's 4 hours. I need to count for 4 hours. When it comes noon, I see where I am. And hopefully I've accounted for 4 hours. Now, it may not all be client service, and that's fine. There's administrative things that need to be done. But make sure you count for your time, because there's only so much time. And it is a reason that you're never going to get really rich being a CPA. Okay? If you think you're going to get rich, this is not the right thing. But you can do well. I mean, you can do well. But this is the problem is you'll never get rich in any business that bills by the hour. Because you can only charge so much an hour and you can only work so many hours. So now as soon as I say that, some CPA will come in and say that he's rich. But as a general rule, it's a good profession, it's a well-paying profession, but there's only so much there. So keep track of your time, keep it honest, make sure it's all there. But the firm will probably have expectations that they'll share with you on billable time. And And you just have to kind of plan things like, I'm going to work this many hours, this many need to be billable, I've got vacation, I've got personal time off, whatever those firm policies are, and make sure you take your personal time off, because you do need to get away from this stuff. And really, and of course, for me, there's continuing education. I need to do at least a week, 40 hours a year in order to keep my licenses and my certifications for being a accredited business valuation. Touch briefly on business valuation. I've got quite a bit of information here, but it's probably more than you need. And this is especially, not every CPA firm does it. In fact, like I said, I get referrals from other CPA firms when their clients need evaluation. Not a lot of people doing it, so it is a good market opportunity for me. And I really like doing it. You really get to get behind the numbers that we don't have time to do that as much as we'd like to when we're doing tax returns and then the normal recurring services. But various purposes that we'll need these, estate inheritance tax, not so much in Indiana anymore for the value of the property because we don't really have an inheritance tax anymore. But if someone passed away and they own a business, you're still going to need to know the tax basis. And the tax basis of that stock or their ownership interest in that business gets adjusted to the fair market value of the date of the death. Well, the only way to do that, if it's General Motors, you just look it up on the stock exchange and there it is. But if it's Family and Company LLC, you have to have it appraised. So that's one of the things we do. I mentioned that we do it in divorce. I recently testified in a trial where husband had an appraiser and a wife had an appraiser, and this case was particularly interesting. But anyway, we had quite a bit of difference in our valuations. So haven't got the decision back. I think mine will stand, but you never know. Shareholder disputes. When it's time for someone to leave, we can come in and say, well, here's what we think the value is and what you should pay them as they leave. Purchase or sale of business, talked about that a little bit already. Planning for the estate, general business planning. Also, sometimes help them develop a buy-sell agreement. Value in a business, relatively new discipline. The methods kind of piggyback on what analysts of public companies, because you'll see, like Morningstar, for example. If you have a public company that's trading, of course, the actual value is on the exchange. You know what you can buy it for. But there's always people who are saying, is that a good deal? Like Morningstar will do a report on a company, and they'll come up with an analysis. This is what we think it's worth. And if you believe their analysis, and if it's less than what it's selling for, you go buy it if you think it's good. Well, small business valuation methods come from that type of analysis. A lot of things we look at the nature and history of the business, economic outlook. We'll start with the book value of the stock because revenue really 5960 says so, but we'll start there with you. We don't start there. So all this accounting we do doesn't necessarily value the company. You come up with the value of stockholders' equity on the books, but that's historical and it may have nothing to do with what the company's actually worth. You look at what the earnings capacity, what the company could do in the future. Valuation is a prophecy. So yes, we do look back and say, well, this is what the weighted average 5-year earnings of the company were, and that's important. But we have to look forward. Can that be sustained? At what level? Will it be higher? You look at dividend paying capacity of dividend paying. This is normally when it's a minority interest. If it's a small, if it's only a partial interest, non-controlling interest, you'll want to know, are they paying dividends? Because if you have a minority interest in a company that's not paying dividends, that's going to substantially reduce the value. Goodwill, revenue ruling 5960 was to look at Goodwill. Goodwill is the value of the company above and beyond the value of the tangible asset. And what that would be is the value of the future earnings stream. So it's very important. This work that we do in accounting to come up with a good set of books is where we start, because that is the earnings stream. It's a matter of will that continue further. And basically what we do, the simple, quick approach to it is you look at what the earnings, you think the earnings are going to be in the future. Say it's going to be $100,000. And generally we do that after taxes. Because the S Corp will make up taxes because somebody's got to pay taxes. Well, let's say it's $100,000 of after-tax earnings. And then you apply a rate of return to it and say, an investor for this type of business and this type of economic circumstances would require, let's just say 20% rate of return. It will be higher than a public, what you want from a public company, higher than what you want on a debt instrument because there's a lot of risk in these small companies. But if you wanted a 20% rate of return, and basically we would convert that to a multiple of 5 times earnings. If we have $100,000 of continuing earnings, we would pay $500,000 for the company. If the tangible assets are only $200,000, the equipment, the cash, accounts receivable, less all the liabilities is $200,000. That $300,000 is the goodwill. And it is risky. I mean, you'll see public companies that have this goodwill booked. You'll see public companies that have, but if you took away the intangible asset, they would be insolvent. But it is real, but it's also risky because it can go away in a heartbeat. If the operations turn and fail, so it's an interesting. It is an interesting area, but it needs to be done because if you want to buy a business, you have to pay something for it. So, I think one of the things I said before is I don't know if I said it was in my material. I need to correct it a little bit. I said the value of the company is the buyer's perception of future cash flows, the value of future cash flows. What I should have said was it's also the seller's perception. It's where the buyer and seller meet, when their perceptions meet. It's just like buying a home. The seller has their expectations, the buyer has their expectations, and it's just where they meet. It becomes the actual value. Small businesses don't have, you have a little bit, a few databases that give you some ideas of what they sell for as a multiple of revenue, but it's tough. They have a lot of other things you can read later. I think we probably need to just open it up for more questions at this point.
Is there any type of business that you evaluate more than anything else? Or is there a type of business that's easier to do versus a harder one?
I would answer them both with fast food. I've done a lot of fast food.
Are they the easier type of valuations, or are they often the more difficult?
They have their complex areas, but they tend to have a decent set of books.
Okay.
And they tend to have numbers that benchmarks that we can find where they should be. So there's a lot of information on them. They have, for example, have a database that has over 2,400 fast food transactions. So there's a lot of information on that area.
And are they buying, when they sell something, are they buying the franchise, or is this an individual owned store?
The franchise has to go with it. Yeah. And that's one of the unique things is when you buy a fast food franchise, you have to, a fast food operator, franchise fast food, or any franchise business, you're going to have to qualify with the franchisor.
Mm-hmm.
And
most fast foods are like that, correct? They're almost all a franchise that you buy, like McDonald's.
right, the ones that are recognizable.
Mm-hmm.
So, which kind of reduces the market because I can't decide, today I want to be in fast food. The franchisors have some pretty strict requirements, like $500,000 in equity, $500,000 in net worth. Usually they want experience in the area that you just haven't started. So it's kind of tough to get in that way, but they do sell, and they are valuable. I just had opportunity, just the people I know, CPAs that I've worked with in my own business, that just had a lot of experience in that area.
I have other questions, but I'm going to wait until you guys answer too. You guys ask.
So you were talking about during tax preparation, if you have prepared someone's taxes and they get audited and there was a mistake, does anything happen to you? Does that come back on you at all? I mean, you're assigned tax preparer, is there penalty for you, or do you lose the client, or what happens in a case like that? Oh, you hope it doesn't happen.
Well, I hope it doesn't happen. I'm not happy if it does happen. First off, we take care of it. We fix it. It's not usually a prepare penalty unless it's really egregious. I mean, taxes are complex. There's going to be mistakes made, and I don't necessarily call it a mistake just because there's a change in audit. It's not our mistake. It's our perception was different than the IRS's, and we decided to just settle it out. But there are situations where there could be a mistake, and we would take care of that. The area that most likely to be a prepare penalty is, of all things, earned income credit. I don't have many. Obviously, as a CPA, I don't have many. But I do. Every once in a while, I do have a client that, for whatever reason, in bad years of business or something, will fall into that. So that doesn't happen very often. That is one of the most complex credits, one of the most complex provisions of the tax law, and very complex. It actually, because there's been so much fraud in that area, people claiming kids that weren't theirs, people claiming the same child, a lot of, but actually has due diligence requirements. And I'm kind of like, if I do all that I'm supposed to do there, I'm never going to get an earned income credit class. But that one actually, if the return you prepare has an earned income credit, and you can't show you've done the due diligence, it's a $500 penalty. So, which is kind of strange. So something that's really for it's going to be on the more otherwise simple returns.
Is it difficult to keep up with all the tax changes? I mean, there's so many, I would imagine, every year. Is it difficult to keep up with that?
It's a challenge. The good thing is we work within the area of our clients, so things, unless it's a general thing, you don't have a whole lot of specific things that affect our clients. But yes, it is a challenge. We do that through annual updates. I go to the Vern Hoven update, 16 hours every January. And I receive emails with updates every day. So, but there's always not only tax law changes, but court rulings and things like new IRS revenue rulings that can have a major impact. And then every once in a while, you'll be doing something in your tax software that doesn't work, and you go, oh, law change. So your tax software helps you out there because they pick up a lot of the changes. Although, ideally, I hope most of the time, at least, I've picked up on it before I started doing the return.
You mentioned that there is no inheritance tax anymore. Like my dad passed away 8 years ago, and there was an inheritance tax. So has that just been taken away in the last 8 years, or?
Yes.
Okay. Because like it was, I had to pay it if it was over 100, if he was worth over 100,000 or whatever that he had left me.
Right.
Okay, that's no more.
There's some issue about whether it's being phased out, but
Okay.
it seems to me that there's no more.
So basically, you can, if somebody passes away and you're the sole beneficiary and you inherit $300,000 worth of property or whatever from them, you don't have to pay inheritance tax on it.
And actually, the recipient would pay anyway. The state.
Okay.
The state inheritance taxes are on the deceased.
Okay. So it would come out of what they had, and then the beneficiary would get the rest.
Right.
Okay.
In a way, it's coming out of your pocket, but
Right.
But the mechanics are.
But you don't see it and then get rid of it. Okay.
How many individual tax returns do you do taxes?
I probably do 80, which is. I don't know how it sounds to you compared to what we used to do. I used to work in a firm that had over 800. There's just not as many to do, and our practice is more tilted more business. So we do a fair number, but and the ones we do are fairly complicated returns. But there was a time when I did 80 returns myself. But a lot of the smaller returns, we have TurboTax, a lot of that's gone away. Anderson has changed a lot. We used to have a lot of mid-level General Motors managers. They're all gone. So it's a completely different environment.
When you do billing, when I worked in the CPA office, that was the biggest change for me. I had to keep track of every single minute, pretty much. And that's, for one, I don't like to do that because it makes me always look at the clock and it makes the time go slow sometimes. But do you have to stop your clock if you go to the bathroom? Do you guys do that? Or if you pick up, if you're working on somebody and you get a phone call and you're talking to them for 5 minutes, do you stop the clock and restart it for that client? How detailed do you get? Or is it common? Not necessarily.
I can stop.
But you'll remember, because it seems like that would be really hard to remember, until you get used to it, I guess.
Yeah, it's, we actually have practice management software that you actually run a timer.
Uh-huh.
And it's just right there. I always have my practice management software up. I have the time input screen. I have another screen that has information about the client. Those are always up. And that screen is always really easy for me to get to. And I'm just accustomed to putting the timer on hold and starting a new timer. Even if it's a short phone call, I won't bother the time. But I actually do. I mean, if it's just a couple of minutes, I'm not dial in the timer run. But yeah, I mean, pretty much it's what you have to do. Every once in a while, get up and forget to start the timer. I think one time I did it. I didn't realize it until the next day that I had like 20 hours. Bill was like $4,000.
Oh, it bills it out its time?
Yeah.
Oh, no.
I think, well, I don't think I can get that out as individual returns, so I have to adjust it. So there's always going to be some judgment involved. There does tend to be a lot of interruptions. But I think I did a pretty good job on it, and I'm just used to it. I'm just used to it. And to follow up on what you said, if there was anything I could change in the CPA firm, could I just quit keeping time? Because people just send me money.
Yeah. Going back to the timekeeping, I know when I first started, the CPA I worked under, if I put down that it was 2.5 hours, she wouldn't necessarily bill the client 2.5 hours because she knew that it took me a little longer because I was new. Do you guys have to do that?
Yeah, yes.
Okay. So you adjust.
You adjust the time to what it really is.
Well, we don't adjust time, we adjust the value.
You kind of have a set figure already kind of in mind, even without doing the time. Like you'll know, if you're going to do a 1040 with earned income credit, and you're not supposed to bill like that. You can't. You're supposed to do that, but you kind of have an idea.
Yeah, an idea.
Kind of like that, going back to the expectation thing.
Right. If you bill the client $300 and there aren't any changes in it, it's a little hard to get $600 out of it. So you have that. Can I explain that? It's tough. It is tough because what if you're doing this to you?
Mm-hmm.
So you have to make that judgment all the time. We've done it sometimes like, I'm having to write this client down every year. After a while, you're like, maybe it's worth what we're doing. I've had different people doing it. It always takes that long. So it becomes judgment. You just have to be able to go to the client and say, this is what it is after a while.
I have a couple of quick questions because I just learned it this summer and it's fascinating to me. But you said that 90% of your clients use QuickBooks. So when you're preparing their taxes or whatever it is, the yearly reports, the quarterly reports, do you have to go back in and error check them before you do those reports, or are you just going to assume that the information that they're inputting on their own is correct?
Well, we test it by comparing items to the documents. And I like to review the general ledger. That's why I like to actually get the QuickBooks file. I'll give you an example of what we've heard about forensic accounting. And there was a fellow who gave a seminar in forensic accounting. And the first thing he said, I want to introduce you all to a new book. And it's called the General Ledger. So he sounds like forensic accounting. We want we're going to do some type of computer analysis or statistical, get the general ledger and look at it. And I can generally do that with my clients. I don't have any clients that will say, we're not going to let you look. Because you can find so much by just looking at the ledger. And you can look at, and the QuickBooks is great. QuickBooks, you can take the general ledger. One of the things I will do, I'll just take the general ledger. You know, it's all chronological. It's just, I'll take it and I'll look at it. I'll go to my general ledger, go to the settings and say, sort by debit, top to bottom. So then you're no longer looking at it chronologically, which has value. I'm not saying it doesn't have value. But look at it, biggest item, smallest item. Sometimes you'll find that in a particular expense account, you've got 3 expenses that are 80% of the account. Just look at those. If those look good, you don't even worry about all the rest of them. And you do the same thing with normally the debit, but you can also do it on the credit side. It's not nearly as many credits. But that would be one thing to do is, remember with QuickBooks, there's more than one way to look at it. You can look at it by vendor, you can look at anything that's on there, you can look at it by. And I find that they're ranking. What I do is looking at the accounts receivable. A good example is a private school, private Christian school. Will have receivables out the wazoo because its parents don't pay, and of course, it's so hard to kick the child out. So they do have full receivables, a lot of them, and the receivable list will be massive. And just go ahead and you just rank it, top to bottom. Anytime you like it, any list that you have. That way you can focus on the major items.
Billable hours. So is there a set rate that CPAs charge, or do you get to charge your own rate per hour, or how does that work?
It's up to the individual CPA.
Okay.
There
was a certain...
There are statistics, however, they're national. The closer you get, it's regional.
There's no gap rules on it.
Pardon?
No gap rules or anything.
No, I can charge whatever I want.
Okay.
Whatever the market will bear.
Okay.
And we tend to charge less. I think CPA firms tend to probably have their place. Sometimes my clients would disagree. But,
they have 28 billable hours.
Yeah. But yeah, it is a very hard. It's an art, not a science, because at the end of the day, you just have to decide what is it really worth, because you can divide that up. One thing we'll do, everybody's got their own billing rate in the CPA firm, but if I have the lower rate, I'm able to push a lot of the lower rate person. Well, does that mean I should charge a client less? You know, if I gave them $28,000 of value, isn't it still $28,000 of value, even if it's not easy to do? And as a CPA, you have to be very careful that you don't underprice. I would say that is our, in fact, between the partners and the administrative people are like, why aren't you billing? And the partners go, oh, that's Joe. I can't bill Joe. But, you know, I've known Joe for, and you have to avoid that. You have to avoid it. That it can only go up 5%. It can't go up more than 5%. Well, you know, maybe there was more work. Mm-hmm. And again, conversely, if there was less work, it needs to go down.
But you never want it to go down.
No, but the phone's always ringing. The phone is always ringing, so we're able to. We have clients. The client list is always changing. People are going out of business. They retire. They sell. They move on. But the list is fairly stable, and we have, like this year, we had some really big projects. And then, of course, next year, well, we don't have those big projects, but there's always something else.
Mm-hmm.
One last maybe question. Yeah, go ahead, Amy.
I feel like I'm asking one question. Back to the QuickBooks thing. Do you feel like that it allows your clients to have a better snapshot of their business so they have a better idea of where they're standing because they have like the snapshots on there where they can kind of keep track of, what their business is worth, basically, as they go? Do you find that they kind of know a little bit more now, or are you still having to, kind of help them through things?
They definitely know more now, and different clients catch on to different things in QuickBooks. That everybody needs something that they hang on to, and it's definitely much better than it was. But there's still room for us. I can still, even if they're doing everything, I can still come back and say, here's your industry benchmarks, and here's how you're doing compared to that. Definitely, it is made of. We have discussions now with our clients. So we did when we were taking the check register and making a general ledger out of it. The clients just weren't all that involved in this way, and it was a lot of detailed work, and it was pretty much here's your report. And now the clients are much more involved, and they'll be asking us questions. A lot of them have an account called Ask Account. when they don't know what to do with it, they'll put it in there and send that account to us every once in a while and just say help us.
Could you list maybe your top 5, I can't remember what you called them, the sensitive accounts, yeah.
For lack of a better word, insurance expense, meals and entertainment, travel, miscellaneous. Yeah, other income, you have to look at that. Professional fees.
One that I had to do that was always the top one when I worked, and people would just randomly put stuff in there, was retained earnings. I always had to go back, and I was always told I had to look in retained earnings and figure out why did it change from last year to this year.
Right, that would be.
Is that one you have?
I didn't say it, but my rule is you do equity first. Because, it's very easy to miss it. It's very easy. In fact, when I started with Haynes and Fenimore, after coming from the national firm, after a few weeks there, they said, John, you're the guy, you're going to be our auditing and accounting manager. So my first job, one of the other partners did a I believe it was an audit. Anyway, financial statement, I reviewed it, we brought it into the managing partner. Here we are, we got it done. He picks it up, turns to page 2, balance sheet. Oh, that's a bit. I was kind of the beginning retained earnings. Ending returns last year is not the same as the beginning this year. And both of us were like, oh, because it's wrong. So that would be my recommendation, that retained earnings especially, but there's also, they can sneak things through capital stock too. Although retained earnings tends to be more of a because clients look at it this way. Well, that really was last year's transaction, so we're going to put it in. Because they don't call it, they call it surplus. That goes way back. So they would throw it in equity because they said, well, it didn't happen this year. And our response is, we didn't catch it, so we're going to count it this year, unless it's of such size that it requires an immediate return. So that's a great point. You have to look at that.
Well,